Mode.
Good morning, everyone. This is Logan Ireland with Insurance Agency Marketing Services in Omaha, Nebraska. I appreciate y'all taking time out of your day today to join us for our webinar. Joining us today will be Brett Walderbach with Voya Financial. He's going to go over the new Quest fixed indexed annuity and different types of cases and clients that can fit in for. Also, we do want to encourage you to stay on for the whole webinar today. At the end of the webinar, you can already get your product training completed for this product and be compliant and ready to go to write that when a case does present itself. First, I want to go through some slides here. Again, here, we do appreciate your time with us. We appreciate your partnership with us. We do everything we can to help you grow your business in your life and annuity markets. Now, and bear with me while I'm having some technical difficulty here. Okay, I did want to talk about our upcoming Life and Annuity Academy. This is coming up July the 27th, 28th, and 29th. It will be in West Des Moines, Iowa. Part of it will be at Athene's back office. Requirements to attend this year's Life and Annuity Academy would be contracting with Athene and having some annuities business submitted into our office prior to the Academy. I will be launching a poll on the Academy later, so if you're interested in learning more about our Life and Annuity Academy or getting registered for it, you can indicate so when I do launch that poll and let us know, or call us at 800-255-5055. Speak to myself or any of the other marketers, and we can answer questions for you and email you out a link so you can get registered for the upcoming Life and Annuity Academy. Our website, a great tool for you there. You can go on and do term quoters. One of the tools I use quite a bit is the income rider comparison tool. So if you're ever wondering, which product's going to give my client the most amount of income in this particular case, that is a great tool there that can help you out if you're working late of an evening or a weekend and can't get to us for some help there. You can also go in and request illustrations 24/7. Our illustration team, when they come in of a morning, they'll see those requests and get those sent right out to you. Easy money now, referred producer program. So you refer another producer to us. All right, we're going to give you a 20 basis point override on all of the business they write. Again, this is our way of saying thanking you for referring us another producer such as yourself. And again, we do appreciate all referrals, as I'm sure. And being in personal production in the past, you always appreciate referrals any way you can get them. The annuity alternative, single premium indexed universal life. This is something that we're seeing a lot of agents and advisors around the country have a great deal of success with. Working on a case this morning with an advisor over in Iowa, has an 81-year-old female client that is in some real estate investment trusts that aren't doing so well, and she wanted to get out of them. Legacy was her goal. Her long-term care risk management isn't in a place where it needs to be, so we're going to look at using a single premium index universal life product there so she can achieve the legacy goal of passing more money on to her beneficiaries, tax-free in most cases. But also then if she would ever need either chronic care coverage to 680Ls, or if she would need confinement coverage. The accelerated death benefit rider has those built into it on most of those products. On the Equitrust Wealth Max, for example, the chronic care pays out over a 60-month period, or they can take a lump sum, and the confinement pays out over a 36-month period. So again, great way to reposition some existing assets such as CDs, maybe some mutual funds that no longer line up with your client's risk tolerance, or any other monies they have out there that aren't lining up with their goals. Help them reposition that and get some additional coverage for their long-term care risks and meet their legacy goals to pass that money on to future generations. Our Top Producers Escape is coming up here August the 3rd through the 7th in Victoria, British Columbia. You do have until the 30th of the month to qualify for this if you haven't yet. $2 million in annuity premium, and I know we were looking at that list just the other day. A lot of agents and advisors out there across the country yet very close to making that. So if you have any cases that you're working on and are close to making the Top Producers Escape, please reach out to us. We'll do everything we can to help you get that business issued by the 30th and get you up to Victoria, British Columbia for that meeting and that beautiful scenery up there. All right, with that now I'm going to turn it over to Brett Walderbach with Voya Financial. And with that, Brett, I believe you have control.
Okay, excellent. Let me get my screen up here. All right. Can you see the PowerPoint real quick, Logan, before we get
Yes.
started? I want to make sure that. Okay, great. All right, well, thank you, everybody. Again, my name is Brett Walderbach. I'm one of the internal wholesalers here for our national accounts. I cover all of our accounts on the west side of Mississippi, of the Mississippi River, I should say. And what I'm going to take you through today is a product-specific training and the complete overview of the new Voya Quest Index Annuity. This will make you compliant for product training requirements through Voya Financial, and there'll be a link that you can do right from your laptop, right from your smartphone if you want to give you immediate credit for the course today. This will be a complete overview from sales and marketing and kind of where these products will be able to fit in for you. So if you have any questions, make sure to hold on to those or attempt to do a Q&A as well. With that, I'm going to go ahead and start the presentation and go through a couple of the quick disclosures here. Bear with me to make compliance happy. And that's our last one. Okay, so any requirements needed to sell the Quest or any annuities through Voya Financial is one, to complete the product-specific training, which we're going to cover here. And then also specific to the state, any state that you're in that is NAIC model regulated, you have to complete either your 4 or 8 hour course, as well as complete any money laundering. We offer this all on the Voya Producer Resource Center, and that would take care of you for NAIC and any money laundering for any additional carrier that you would do business with. Also, we have our business guidelines. These essentially serve as a framework to all of our producers that they're responsible for upholding and embracing ethical market conduct as a part of everyday business, and really, being the best representation, for themselves and their clients while representing Voya Financial. We also have suitability guidelines. At Voya, we definitely understand that there is really no one-size-fits-all, and there is not a box that we operate in when it comes to suitability. Every case is unique, and we want to give that its unique attention. So some points to really consider are highlighted here, but a couple things that you'll want to make sure that you're taking a look at, tax status, age of the client, financial goals, annual income, any withdrawal needs, and also total net worth and liquid net worth as well. So those are just some points of consideration inside of there. But every case is unique, and we will handle that as a unique case as well for you. General advertising rules. Anything that is used will need to be approved by Voya Financial if it's not already a piece that we've provided for you. So whether that's website material, billboards, direct mail, radio, magazine, television, prepared sales talks, presentations, or seminars. So we have a lot of these already put together that are client approved, rep approved, so that way you don't have to go through the ad review process. We'll take care of a lot of that stuff for you. We can do some customization. If you're affiliated with a broker-dealer, you'll want to get a sign-off on that before use. Also, any lead generating material that you're using, just want to make sure that you're not referencing seniors on there. It's clear that an annuity is being sold. It doesn't look like it's something that's official from like the IRS, FINRA, etc. And we want to make sure if you're using any telemarketing that you're following all state and federal rules when it comes to telemarketing and observing those do not call lists. Okay, so let's get into the meat and potatoes here. So our new solution. So a little bit of background is this is the first major product rollout that we've had in over 10 years. So and these will currently replace the current secure index family of products. There's a 90-day sunset path as the state approves the product. So the Quest products are going to offer a Quest 5, Quest 7, and Quest Plus index annuity. So a 5-year, a 7-year, and the Plus is a bonus product that is on a 10-year surrender. With this, we've also brought on a brand new income rider called the Voya My Income Withdrawal Benefit. So that's giving you more guaranteed roll-up, a higher maximum annual withdrawal percentage, and more favorable surrender schedules on the 5 and 7 products. And I already mentioned the Quest Plus is a bonus product. So as you know, equities in the marketplace definitely have their place, because an index annuity or a variable annuity or a CD can't really take care of all the client's needs. But what they don't offer when they're 100% in equities, whether it's mutual funds or stocks individually, there is growth but no downside protection. And here's some of the math of market downturns. So you look here, you got 2000, 2001, 2012, the first 3 consecutive years of a market downturn. So that's your tech bubble right there. And clients tend to think that, well, if I'm down, 10.1% in 2000, I only need, 10.1% just to climb out of that hole. That's incorrect. They actually need 11.2%, and the further your downturn is, the more magnified that is. So let's look at 2008. So we have, a loss of negative 38.5%. So you need 62.6% just to climb out of that hole. So, and that typically in 2008 took a 5-year recovery for clients to get out of that hole with a sequence of returns. So now we have opportunities to provide the client some protection. Some of the more popular things that they might be used to are CDs, which are fully taxable. So fully taxable bond funds, which are not offering 100% downside protection, but they're typically some of your more safer investments in the marketplace. But with the loom of a potential rising interest rate environment, even 1% could have drastic impacts to bond holdings. And again, they're both taxable. Or if you look right now, the average indexed annuity as of November 2015 index companion is averaging a 4.4% return. So first and foremost, there's 100% principal protection. And then you have the growth linked to your benchmark that is tax deferred. So a great alternative for those clients. So here is kind of a snapshot of the breakdown of the Quest products. If you can understand just one of these solutions, you'll be able to easily pivot from the 5 to the 7 to the plus. All you got to know is one, because there's very differentiation of the story with these products. Type of plans that we're going to take. So non-qualified, traditional IRA, Roth IRA. So we'll do simple and SEPs on our flexible premium plans, the 5 and the 7. We can do beneficial IRAs. We can do beneficial Roths. We can do non-qualified stretch contracts. And then we can look at other type of qualified plans, your 401ks, 401as, defined benefit plans, profit sharing, money purchasing, HR10, etc. are all available to be able to written on these 3 products. Our minimum premiums are $15,000. We have a maximum without back office approval of $1.5 million. So for the 5 and 7, I mentioned those are flexible products. So the subsequent premiums minimum is $1,000 at a time. The client will get a statement so they can effectively manage each premium anniversary that they have in there with those subsequent premiums. We will offer premium banding to how we price caps and spreads. Our low band is anything that's above $15,000 but under $75,000, and then the high band is $75,000 and above. With a flexible premium plan, you have essentially the first year with contributions to bring it into the high band. Once that first anniversary hits, you're either locked in your or you're locked in your high band. A distribution or a contribution would not pull you out of there after the first year. Interest will be credited annually on the premium anniversary. These will all feature a fixed bucket option if they want to participate. That's got a guaranteed minimum rate of 1%. So they'll be given a rate each and every year that they can elect to participate in. All these contracts will feature a charge-free amount after the first year. If anyone needs a distribution inside the first year of the contract, there's a couple of ways they can take care of that. They can just take the interest in advance from the fixed strategy, whatever's allocated in there. So if you have no allocation to the fixed account, that option becomes unavailable. If you have an RMD need for any client 70.5 or older with IRA money, and then if they have an income benefit, if they want to activate that in the first year, they could, and there's no penalty. Otherwise, you can take 10% of the accumulation value free of any market value adjustment any time after the contract year 2 and beyond. So once it's out of its surrender, you can take as much as you would like it as a liquid investment. All the contracts feature a market value option. If they do an early surrender, that would be a 5-year, a 7-year, or a 10-year MBA opportunity. And then if they want to annuitize the contract, which typically isn't done these days anymore, but it can be done after the first year for the cash surrender value. So just a couple of the different values on there. You do have the cash surrender value, which is the accumulation value minus any market value adjustment, surrender charges, or bonus for capture. So, or it's the minimum guaranteed contract value, which the minimum guaranteed contract is essentially 1% compounding interest calculated separately, which is a completely different account off the contract, the 87.5% of the premiums, and less any premium taxes. So I don't want you to get hung up on there. You know, those are some of the things that we have to do from the Guarantee Association. That is the worst case scenario of a contract of insolvency. We have the death benefit, which is going to be the greater of the accumulation value, No MBA, no surrender charges, no bonus recapture, or the minimum guaranteed contract value, or another shadow account, the minimum persistency value, whichever is the highest at death. So that's a nice transition to probably a new term that you just heard, which is a minimum persistency value in the contract. This is, again, another shadow account, but it equates for 100% of your premiums with no interest earning on them. But what this really is after your surrender period is up, say you had a 5-year product that didn't earn any interest based off the strategy for 5 years, it's an in-writing premium guarantee. So at the end of the 5th year that you at least have your premiums right there, and that if it's the highest amount on the contract at a surrender, less withdrawals, then that will be what's paid out at a minimum. All these contracts will feature a nursing home terminal illness waiver that are available after the 1st year. So the nursing home is a waiver of surrender charges after 45 days of confinement during a 60-day period, again, after the 1st year. The 45 days does not need to be continuous, but you need to be able to attach it to a 60-day continuous period. So you could go to a facility, leave for 2 weeks, and go back and never go home again, and then we would provide a waiver of surrender. Terminal illness is very similar. It's a waiver of surrender charges if a terminal illness is diagnosed with a life expectancy of less than a year after the 1st anniversary. Both of those cover pre-existing conditions. So here's a snapshot of the Quest 5 annuity, and this is a non-registered flexible premium product. So if you look at the surrender schedule, if you add on premiums in any year, there is not a continuation of the surrender. It is one 5-year period, and then we would adjust what your cash surrender value is based off of the additional premiums and what the surrender, where it is in the surrender schedule. Again, it does have a 5-year market value adjustment, and we've made an upgrade from the current Secure family where there is no more 0.5% reduction after each year of the contract. It's a full 100 basis points waterfall from 8% to 4% in the 5th year. One of the great features that we were able to keep inside of this product was our return of premium rider. So this is my affectionately called get out of an annuity free card. So essentially what that does, if you have a 5-year product and you have the return of premium, you've taken either a lower cap or a higher spread as your opportunity. We're not charging you an actual fee. So, and if you absolutely in that 3rd, 2nd, 1st year outside the free look period, 4th year, you need to get out of this contract for whatever reason, or it's just not a good fit for you anymore and you want a 1035 or transfer it, at a minimum, you will get all of your premiums back, less any distributions and premium tax if it's applicable. So if it becomes not a fit, maybe it's 3 months after the free look period and you want a 1035 it to a different product, you can do that and at a minimum have all your premiums back. We will take a look at your cash surrender value. So if there's an opportunity to keep some of your interest, you'll retain that, but you'll give up some of it in there. Otherwise, if it puts you below your initial premiums, you're just made whole. The Voya Quest 7 indexed annuity, the only real difference here is there is no return of premium. So, and it's 2 years longer in duration, giving it more favorable caps and spreads. So a major upgrade on the surrender schedule to make it more favorable to the client is it used to be 10% surrender for the first 4 years, and then it began to waterfall by 1% in the 5th. No longer is that the case. So now it starts at 9%, and it continues to waterfall by 100 basis points each and every year. So the 5 and the 7 are great kind of what I would call, CD cash alternatives. Clients that are really not doing anything in the marketplace right now want some better upside than typical cash certificate deposits or even just their savings account. This is a great way to give them a little bit of liquidity and some tax-deferred growth with 100% protection of principal. A great way to also get some risk out of their overall investment portfolio, maybe taking some of that fixed income, placing it here and attaching an income rider with it. The Quest Plus is our single premium product, so this will not allow any subsequent premiums, and we are giving it a 6% immediate bonus. One thing to take a look at when you're looking at index annuity is not all bonuses are created equal. And I say that because if someone put in $100,000 here, you get that money immediately. You don't have to wait until the 4th year of the surrender starts, so you've completed 3 anniversaries. You get it day 1. So, and then we have a recapture schedule if you leave early. If you break the contract early, you'll give up some of the bonus you took immediately because it starts earning interest right away. So you also have the ability to take a 10% free withdrawal of this contract and not touch the bonus. The only time that the bonus is recaptured is if the client were to die in the 1st year. The rep is not charged back, but the client does pay back the bonus. If there is an unfortunate death in the 1st year, there is no penalties on anything else on the contract. This is a great accumulation story for those large lump sum rollovers where the client likes to get a little bit of extra to put in there to start off their accumulation growth. Okay, so now that we've gone through the three core products on here, now here is the Voya My Income Withdrawal Benefit Rider. This rider can be attached to any of those three products. They are created equal because the bonus is given to the accumulation value on the Quest Plus. But on here, you have the opportunity, if you're 50 or through 80, those are the ages where you can sell this to, you'll get a 6.5 compounded roll-up to the benefit base compared to the old 6% compounded roll-up. So not only do you have a higher roll-up, but you have the ability to really receive the income whenever you would like to. It could be for an individual or spouse for the same fee of 100 basis points. So this fee is locked for the first 5 years. So it is subject to an increase in the annual charge. So this is a kind of a perceived negative, but with this low interest rate environment and the realization, if you do any research on negative interest rates, we're essentially protecting ourselves with having a fee change possibility after 5 years if we get into a negative interest rate environment where we have to adjust the fee of the rider. The double-edged sword of this is if we increase that fee, it is a quicker depletion of the client's accumulation value, which allows them to burn through their money first, and as soon as they get on the hooks of the insurance company, we're paying out all our money essentially and no longer a return of the client's money. So it is a double-edged sword, but it definitely gives us some flexibility if the rate environment were not to improve but get worse and the product wasn't profitable. If we do raise the fee, the client has the ability to terminate that rider if they would like to. So this is an example where a minimum persistency value could come into play. Let's say if you have a client looking for short-term income needs and some short-term accumulation, you sell the Quest 5. You use the monthly cap index, which you're getting very aggressive and you want to take advantage of all the accumulation you possibly can as a secondary need because first of all, you're trying to solve for income down the road 5 years later. So in 5 years, the fee goes up to 110 basis points. So, but the client's needs are no longer income 5 years down the road. So now I didn't get any credits for my monthly cap, hypothetically, but I've also 5 years a fee of 1%. So I could either surrender this and I would get the greater of my premiums, the minimum persistency value, or my cash surrender value. Well, my cash surrender value is no distributions out of there, it's just fees paying. So if you choose to exit, we will just pay you back your premiums if you want to terminate that rider and surrender the contract in full. Or if you still have the need of income and you need that 5 years down the road, you can activate that rider at that point. You will still pay the higher fee, but you're in a depletion portion where you're spending through your accumulation value and getting into where you're receiving that lifetime payout. So again, the rider can be elected at any time. There is no minimum wait period. So if you need it right away to satisfy your RMDs, it's right there for you. So the income can be turned on and off. So the MAW, or the maximum annual withdrawal percentage, is based on your actual age of attainment. While you're deferring that rider, you are getting an increase each and every year to what your withdrawal percentage would be. There is no 10-year, 15-year blocks before an increase. It happens every single year. Once you elect that attainment age, it is fixed for the life of the contract. So that's a nice transition to take a look at what are the withdrawal percentages on the My Income rider. So typically most people will think that income riders right now are being activated at age 65, which only about 20% of all annuity contracts are commencing their riders at 65 right now. Over 50% of them are being commenced at age 70 and a half. So 1 year before the client turns 71 and a half. Or, yeah, 70 and a half, right when they needed to start taking RMDs. I apologize, I got out of my head there. So if you take a look at our schedule here, at 70 and a half, if you were deferring this, maybe you purchased it at 65, deferred it for 5 years, 5.25 would be your withdrawal percentage. So you could use that to satisfy your RMDs. It's going to be more than enough out of there. You'll be able to take that for the rest of your life, or you could do a joint life. It's just a 50 basis point reduction. If you continue to want to defer that, it increases 10 basis points each and every year. So not only with this rider are you getting 6.5% roll-up guaranteed, that's compounding interest, you're also getting an increase in what the payout will be for the client. There is no additional fee if they choose joint life. It's the same charge. Okay, so transition back to some of the terminology in there. So we have a market value adjustment, which I'm sure almost everybody is fluent with. So when does an MBA apply? At the time of a partial surrender. So if you take more than the charge-free amount, we will apply a market value adjustment to the remainder of the contract, what's left. So it might incur some additional penalties or additional credits, depending on if it's a positive or negative impact. If you do a full surrender early, that will also generate a market value adjustment. So when doesn't it apply? If you simply play by the rules of the contract. So if you take the charge-free amount, it's not going to apply. So if you fully surrender the contract after the surrender period, it's no longer applicable. During the free look period or during death, there's no MBA applicable. Also, if you have an income rider, if you activate that, again, you could activate it in the first 30 days, and there is no MBA to the contract. You're just activating a feature that you already have in the contract. When would a positive MBA apply? So in general, so if we, right now we're at about 170 for the 10-year Treasury. If 2-3 years down the road, interest rates continue to decline, and say we're at 80 basis points for the 10-year Treasury, well, there will likely be an increase because of the MBA, because we can sell, these current bond options in the contract at a premium, so we can, share in the gains to the client. It's negative where we are in a historical low interest rate environment, and we see, quantitative easing over the next couple of years, and interest rates rise from 170 basis points to say 300 basis points. Then we're going to have to sell these bond options as a discount, and you're going to share in the loss. So it puts a little bit more onus back to the client, and some of the risk of early surrender in the contract allows us to put more rate into the cap and the spreads and give them some higher upside potential. So that's a nice segue to how are we offering diversified crediting strategy. So we will have 5 options at launch for these product suites. We will have the fixed bucket, we'll have the point-to-point volatility control, the monthly average, the monthly cap, the point-to-point cap will be available at launch. Other strategies that will be filed on the products and disclosed in the Understanding Your Annuity contract or the product disclosure, the point-to-point participation, performance trigger, inverse performance trigger, and interest rate benchmark. So we reserve the right to open and close any strategy at any time, and that way at renewal, the client would have the ability to continue to participate if we close one down as long as they're already inside of it, or elect into anything new. If we close down one that they haven't participated in and something new comes up that they like, they can benchmark inside of that. So let's kind of go through some of the marketing material. So inside of our kits, we've really tried to simplify these and provide less pages. So you'll have a sales concept brochure around the specific product, and then you have a chance to hand select one strategy or a couple of strategies that you want to share to your client. No more you're going to have clients being distracted by 14, 15-page brochures that show an example of each and every crediting strategy, showing them some unwanted material that's going to cause maybe confusion. So if you like volatility control and you like the 7-year product, then you can have that brochure with the 2-pager on the volatility control strategy. It's got hypothetical case study in there, right there in your sales kit. Simplified sales process, making it a nice, easy, customized story. So a little bit of an overview on the Voya point-to-point volatility control. This index strategy is based off the annual percentage of change of the Croaky US 5% vol control index. So less a spread. There is no cap on this strategy. Once you overcome your spread, the rest goes to the client. The volatility control index is brought to us by Deutsche Bank, one of the largest institutions in the world. So, and what they're providing you is exposure to the 40 U.S. stocks that are the most honored value of the top 250 of the S&P 500. So it is a subset. There's a target volatility of 5% inside of here. So we are very transparent on how this works. Your equities are the Croaky US plus 2 index, which again, top 250 companies of the S&P 500. They're doing their P&E ratios to determine the 40 most undervalued stocks, so the best discounted stocks for your growth opportunity in the S&P 500. Then the control measurement is cash. We're aiming to keep volatility at 5%. That is realized volatility. So this is a nice segue of how this works. So if the volatility increases in the marketplace, then we are going to pull you away from your equity exposure as much as needed to keep it back down to 5. We're just going to put back into cash. If the volatility decreases and we don't need to put as much cash in there, then we will put you with more in equities. This can be anywhere from 0 to 100% either way. So we will continue to take a look at what's the greater of the 20 or 40-day realized volatility, not the assumed volatility. CROCI is an acronym for a cash return on capital investment. Again, it's Deutsche Bank's proprietary evaluation method using equities. So again, there are 40 equally weighted stocks that are rebalanced monthly inside of there. So and this is a subset, again, of the S&P 500. So here's a look at a case study. So it is annual point to point. So day one, we have a starting value at 2479.46. 365 days later, so 2772.84. So that is 11% or 11.83% growth in the indices. So the spread for this example is 2%. So the client has overcome that spread. They keep 9.83%. If there was an example where this was 1.83%, we do not take away our spread. The client's protected because they didn't overcome it. There's just no credit made. If it were negative, protection of principal. This benchmark resets annually. All interest earned based off the index is locked in and protected as well. So the next year, if they started at the 2772 but it ended at, say 2100, they didn't lose the 9.83% credit the prior year. That's locked in. Another strategy that features a spread is our very popular monthly average index. This is 100% S&P 500 base. This is not a blended strategy. There is no control measurement. It is a way to smooth out kind of the ups and downs of a volatile market. So this is actual S&P 500 numbers from 1997 calendar year. So at the beginning of January, we started at 740.74. So that's our starting index value. Now we have a 30-day month anniversary, as I call it, where every 30 days, not calendar days, but true 30 days from an anniversary each month, we will snapshot what is the S&P 500. So right here we have our 12-month scorecard. So we add all these numbers up, divide them by 12 to give us an average S&P value for the year. So in this contract year, the average was 875.86. Take that over the starting value, we have 18.24 percentage of growth in there. So here is a hypothetical spread of 5%, which is a little high compared to the pricing of the products. Typically look like a spread of a bonus product. The client would take a credit of 13.24% home. Again, this was reset annually. Credits are locked in each year and protected. If the spread cannot be overcome, there's no credit made. If it's negative, they're protected. Monthly cap index. So this is a little bit different. Now we're calculating percentage of change. This is a strategy that is wonderful in a consistently rising bull market, where we were about 6.5 years ago from now, when this bull market was first incepted. So we're taking a look at the percentage of change every 30 days with a 30-day reset. So we are essentially keeping a scorecard very similar to a golf, all the pluses, all the minuses, and then we add them all together. So the downside of this story is in a volatile market. If you have, like we experienced the first half of January, let's say your anniversary was the 14th, well, February 14th would have been one of your month anniversaries. It's down 14%. Well, you would be negative 14%. You'd have a hole to climb out of. That 1 month could ruin the whole year. So a volatile market that's not steadily growing, this could be a pretty risky strategy. So if we add all these 12 up, we have a credit of 8.56. The client takes everything away. This is 100% participation until you hit what your maximum 12-month cap could be. The point-to-point cap index, this is what I like to call old reliable. So this is the most consistent crediting method in the industry. 76% of all annuity contracts are at least benchmarked to a portion of this. So day 1 to day 365, what's the percentage of change? So in this example, the cap was 5%. The index actually performed at 3.53. So you get all of that 3.53. We reset the benchmark for the next year. We lock in those gains. The point-to-point participation. Now we're into the strategies that are not going to be available at launch, but filed on the product, so I won't spend a whole lot of time here. So you'll be given a participation rate. In this example, it's 40%. Day 1 to day 365, if the market's up 13.6, you get 40% of that, so you get 5.4%. With participation rates being so low right now, that's why this product is being, or this strategy is chosen to be closed at launch. Performance trigger. This is a different way of looking at the annual point-to-point cap, but instead of giving you a cap, we're going to give you a declared trigger rate. So we're going to declare a rate, let's say 3%. If the S&P were to be 0% or greater for the calendar year, day 1 to day 365, then we will give you the entire trigger rate. So this example, we're 2.04. But let's just say it was 0.04% growth. You would still get 3%. Or if we would have a unique anomaly where it's truly flat, starting value 1286.12, ending value 1286.12, a lot could have happened between, but you're totally flat for the year, and we will still give you the 3% trigger rate or whatever your declared rate is for that year. The inverse trigger is the exact opposite. You want a down year. You're hedging against an inverse play. So as long as the S&P is negative, even by 1 basis point, you will get the declared trigger rate. So we have a performance and an inverse for when you want the market to be down, bear market strategy. Interest rate benchmark, the last one of the strategies here. Again, this, along with anything else from the participation, are not available. This is a play against rising interest rates. So this is currently available on our Wealth Builder family, and it is a 3-month LIBOR, so the rates of what banks are lending one another, and we're looking at their 90-day note. It's the annual percentage of change. So in this example, 1.15 to 2.56, a little over 130 basis points. So we take the percentage of change times 4, which is your participation multiplier, to try to accelerate you to your 10% cap. In this example, it's 5.6%, and that's what the client's credited 0% or 100% participation from 0 to 10. So wrapping up the presentation here, we have built a dedicated microsite. This will give you everything you want to see, from sales material, strategy brochures, client-approved videos, state approvals. You no longer need to go back for the product training because that's being done. You can order kits, illustrate the product, all right there for yourself. That's Voya Quest Annuities.com. I highly recommend you taking a look at that. We have wonderful client-approved sales videos on there for each product. They're about 4 minutes long, and they do a lot of the heavy lifting on client product education. So where this is being used the best, client comes in the office for a meeting, offer them a cup of coffee or something to drink while you're getting that for them, have them sit down and watch the video to do a great product overview for you, making for a more robust conversation and allowing them to answer some questions on the product. With that, I mentioned today you're going to be able to satisfy your product-specific training. So what I want you to do is, if you have your cell phone handy, if you have a smartphone, or if you have a second screen on your laptop, to take it over there and type in www.brainshark.com/Voya/Quest PST. So this will prevent you from having to take this all over again. And I'm going to quick pull up that site here so you can see the complete walkthrough, because there is a guest book. And even if you're not currently appointed with Voya and you're considering getting appointed with Logan and having him get that appointment set for you, you have the opportunity to already have your product training out of hand beforehand. Okay, so let me show my screen one more time. So this is what the guest book looks like. So I'm just going to go ahead and put in my name, and I'm just going to fake the email address because I'm not an active producer. If you give it the bogus information that I am, that it won't be able to match you up in the system for when you do get appointed or if you're already appointed. So this is just a quick blow through for me. Okay, so once you hit submit, it's going to take you into the attestation. So I've already done it, so I want to start over. So you check that you've been through the presentation, and then you hit submit, then it's going to say correct, and then you hit continue to go to the next spot. What city was the training held in? That previous slide said Des Moines. So capital DES space capital MOINES. Submit, it'll say correct. And then it'll say what was the topic of the training. Very simple, capital PST. So it needs to be exactly that. That's how we built the questions. Submit, it'll say correct. Done. What is the passcode? Today's passcode was, Voya with a capital V, 92. Let me cheat to confirm. Yep. Hit submit. Correct. Okay, now I want you to pay attention to the top of the screen here. Right now it says you have not met criteria. Give it about 5 seconds, and that is going to change with that green check mark. Now you're all set. You're all done. Product training has been completed. With that, that concludes my presentation. Logan, if you'd like to have an opportunity to open up for Q&A, I'd be more than happy to answer any questions for anybody that's got questions out there.
Oh, you bet. Thanks, Brett. Appreciate that. And Yeah, pretty simple product training there as far as that goes. So we'll. Are you hearing me okay, Brett?
Yep, I can hear you just fine.
Okay.
So I don't know if it helps out, but I know typically attendees have a raise their hand functionality.
Yeah, we do have
If
one
that's an easy way to
question
identify.
here. Gentleman in New York State is asking if this product or anything similar, or do you have anything available in New York State?
So we don't file any of our products, unfortunately, in the state of New York. So with Reg 60 regulations, we just don't go through the battle. But it is approved in New Jersey. If you are licensed in the state of New Jersey, anyone that could purchase it in that state or the surrounding states as well.
All right, and any more questions? Just launch those questions. I'll be able to read them here. One question here: what are the chargebacks, commissions, and are there trail options?
Good question. So the chargebacks go as following. The first 6 months of the contract, it's 100% chargeback. If they surrender in months 7 through 12, it's a 50%. So after the 13th month, the rep is free and clear of any chargebacks. And then also, if you add on the 5-year product, that return of premium feature, that get out of annuity free card, for that one product only, it extends the chargeback period. It is 100% in the first 12 months, and then it is 50% in months 12 through 24. Year 3 is when you're free and clear of a chargeback on that. Typically, that's not a huge deal because if the client does utilize the return of premium, if they're seeking guidance of their original rep and advisor, they're typically helping them place that with a better fit product. And whatever commissions they're losing, hoping they're making back up with the new product sale. And then for trails, yes, there are trails on each and every one of these. So there is an option A, which is all up front, all the way through B, C, and D, which are variations of less upfront, more trail. Trails are paid in the end of month 15 and quarterly going forward.
All right. The question is, why they use the 1997 example instead of 2006 or 2007, possibly.
Yeah, I'm not sure. That's what we've typically. It's a similar strategy that we've used in all of our marketing material. And that one's pulled from Volatility Has Met Its Match brochure that we have, our one-pager. I know in the client piece we use 2010 example in there. Our Present software will take you from 2015 and assume that your client has turned 95 that day when the contract would mature, and they would either be forced to annuitize or surrender or activate their income rider, and it runs all the way back in time until we land on their current age. So we will provide you anywhere from 40 to 30 to 35 to 20 to 15 years of data on that. That's just what compliance has pulled out for the example of product training. So that is a very good question.
Good. Next question is, when is the launch date of this product? And I will add a follow-up question, how many states has it been approved in already?
Yeah, absolutely. So we are at 30 states, and we are launching on June 13th, so next Monday. So if you go to the Voya Quest Annuities right now, the product looks like it's for sale. You can order kits. You can run illustrations. Every time you grab something, it'll give you the disclosure. Contracts are not to be signed prior to Monday the 13th. But you can start soliciting this product now that you've had product training, and if you have, you can get your just-in-time status appointment with Voya. And then if you would like, I could pull up. There is a state approval grid on the Producer Resource Center. So let me throw that up here for everybody. So here is the state approval, and then we have about another 8 states that are going to launch on July 15th as well. And those aren't updated on there yet, but I know if anyone in North Carolina is on there, New Jersey will be the July 15th, just a couple of notable states on there. But here's the current availability as of the 13th.
And that gets us to the next question. Is it approved in Maryland, D.C., and Virginia? Looks like...
Maryland, yes. D.C., yes. Virginia, I believe, is on July 15th launch. I would have to double check that and get that back to you offline, Logan.
Okay. And I can always reach out to that person there. Let's see. Florida was our next question. Is it approved there?
State of Florida approval?
Yep.
Yes, it is approved for Florida at launch.
I've got some questions here about going back and showing different slides with info on the product training. This is going to be a recorded webinar and will be on our YouTube channel. Grab a piece of paper and a pen right quick, and I will give you that address to our YouTube channel. That is going to be youtube.com/IAMSINC. And as soon as our tech people can get this put together, that will be posted to our YouTube channel there. You can view that at your convenience. I will also be calling and reaching out to most of you to follow up on this. If you would like a copy of this presentation, the PowerPoint, you'll be able to forward me the PowerPoint presentation on this one as well, correct, Brett?
Yes, correct. And one thing I want to let you know, so this slide right here is good through this Friday. So the passcode will change on Friday. So that'll be the only thing. If you miss out on that, you can always go to the website, redo the PST. It's a non-audio version. It takes about 11 minutes to click through all the different slides, but all those slides are out there as well.
Okay. Why don't we leave that slide up for now then while I scroll on through some additional
absolutely.
questions in case someone else wants to make sure they get that written down. Let's see here. Chargebacks on death.
No chargeback of commission on death. Only a bonus for capture in the first year on the Quest Plus.
Okay. And okay, so we've got the Brainshark URL back up. We've already got that question answered there. Yeah, training site. There we go. All right. This says, can the FPA be used for TSA or only monthly bank draft contributions?
Can you repeat the question? I apologize. I want to make sure I knew that.
Yeah, it says, can the FPA be used for TSA or only monthly bank draft contributions? They'd have to meet the $1,000. Well, yeah, I'm not quite sure. I think it has to do with sub pays going in. It sounds like there was a $1,000 minimum sub pay on the flexible premium.
Yeah, there is a minimum. I know, like on SIMP and SEPL plans, there's kind of an unwritten waiver on there because they'll have employer match, and a lot of those might be a couple $100 at a time. As our stance is, we don't refuse it, but it's our published contribution minimum. So, and they can be set up EFT. So especially, I would say we offer SIMP and SEPL plans. The payroll can enroll into that plan from the website and set up EFTs right from their bank account.
And then, as I said earlier, yes, this PowerPoint presentation will be available. I will, as I said, as I call to reach out to you to follow up on this. If you'd like a copy of that PowerPoint presentation, let me know and I can forward that out to you, or simply call me at 800-255-5055, request it, or send me an email to Logan, Logan, at IAMSinc.com. That's IAMSINC.com, and we'll get a copy of this PowerPoint presentation sent out to you there. And let's see, Wisconsin, approval in Wisconsin.
Let me switch back real quick. Yes. Okay.
The YouTube address again is youtube.com. That's youtube.com // that's going to be your question mark key when you're not shifted there. Then IAMS, the acronym for Insurance Agency Marketing Services. Follow that up with INC, the abbreviation for Incorporated, and that will get you to our YouTube channel there. And then you can, again, view this, and 90+% of our webinars are recorded. We occasionally do run into one that's not client approved, so we subsequently can't put it out on YouTube. But for the most part, we are able to record and post every vast majority of the webinars that we do on our YouTube channel. Minimum maximum issue ages for the product, Brett?
Yeah, 0 to 80, owner and annuitant. So, and if you have non-natural ownership, such as like a trust, then we just need the annuitant to be 0 to 80 on there.
Mm-hmm. Two states that are a little more difficult to get products approved in, Oregon and Washington State. I would guess they're probably going to be in the July timeframe.
Yeah, they're currently responding to objections for, I believe, both of those states. So, yeah, Washington's still not on there, and I believe Oregon was the same way, yeah. So I believe that those were recently filed within probably the last 45 days, and we've received objections from the last update that I was on.
Is there a trail commission option available with Voya on this product?
Yes.
Okay.
Yep.
And it's paid out quarterly,
so commission
correct?
schedules will be, yeah, they're paid out quarterly, and then we'll be able to have commission schedules for a launch on the 13th, whether if they call IMS's internal team or they want to call our sales desk team, we'll be able to provide those.
And looks like that is it on the questions. So do appreciate all that. Now I will resume control of this and try not to hang up on you in the process, Brett, like I did last time.
Okay.
And then we can, okay, here we go. So I'll right click, retake control. And you still with me, Brett?
Yep, I'm still here with you. Excellent.
Okay, perfect. Now we'll go back to some of our slides. Actually, you know what? Why don't we do this? Why don't I, well, for me to launch the polls and get the poll questions out there, I'll have to maintain control here for now. So, and it's not going to let me back up, but that's okay. We'll look at a black screen here while we ask these poll questions. Okay, so first, I'm going to launch this poll here. Would you be interested in attending our Life and Annuity Academy? And I'll leave this up for a minute or so here. The Life and Annuity Academy, what we do, we host a few of these every year. We'll bring producers in from across the country, fly you in at our expense, put you up in a hotel room, feed you, get you in on a Wednesday afternoon, give you plenty of time to get settled. We'll get together Wednesday evening, orders, cocktails, go through some presentations. You'll see everything from product presentations revolving around income riders to different life products and sales ideas there. We'll also have some of our coaching partners. If you're interested in learning about doing Social Security seminars, adding that to your marketing efforts to grow your client base that way, we are working with several agents and advisors right now that have implemented the Social Security planning seminars, and it is leading to some very qualified leads and very good business as a result. Then there, if you want to delve into dinner seminars, things of that nature, we have another coach that we're partnering with there. All that gets discussed in great detail at the Life and Annuity Academy. As I said, we'll also go into sales concepts, things of that nature there. Training all day Thursday, then normally at the carrier that we partner with back office, and this year it is going to be Athene. That is why we would have the contract requirement with Athene for you to be eligible to attend this academy. And then again, the other eligibility requirement this year is submitted annuity business prior to the academy. So if you're interested in registering for the academy, learning more about the academy, if July the 27th, 20th, and 29th doesn't work out for you this time, we will have another one coming up in the fall. Those dates will be announced here not too far out in the distant future. But if July doesn't work for you and you're interested in attending a future academy date, you can always let us know that as well, and we'll get that information out to you as soon as we do get that scheduled for a future date. But past attendees to the academy, give it a thumbs up, a great value there. I know I can speak for one advisor that I've worked with here for the last year. He came to our academy last August and has embraced the Social Security planning seminars and has broken the $2 million in annuity production level with us since then. So he's garnered a lot of value and a great deal of success from attending our Life and Annuity Academy. And if you want to look into growing specifically your annuity and life markets, sign up for this academy. We'll get you some more information. We'll have the opportunity to invite 45 agents to this year's academy that's coming up in July. So with that there, we've been up for 3 minutes now, so I'm going to go ahead and go to my next poll. Next poll question here. All right. We'll do contracting for Voya. If you'd like to get contracted with Voya, click yes here. That'll show up on a spreadsheet for me. Then I can get you contracting paperwork emailed out. We do use a universal licensing form. We keep that on file here. That saves you the time from having to fill out multiple contracting paperwork. There still are a few carriers out there that you either have to go to their website or do it the old school way. But again, 90+% of the time, we can get you the agent data packet or our universal licensing form. You'll get all that information filled out. We'll keep it on file here. We can get you contracted with Voya and any other carrier you want to get contracted with. And as long as we have that information on file, if we're working on a case in the future and we come across a carrier or a product that's the best fit for your client and you're not contracted with that carrier yet, now we've got all the information already on file to get you contracted with that carrier just in time and do what we can to get that contract in place as quickly as possible so that you can meet that client's demands and get that business written. So do appreciate you all voting on that. We'll leave that up for another couple more minutes. Brett, you'd mentioned some numbers there earlier about, people when they trigger an income rider. Approximately 20% of them were at age 65, but over half was at RMD age when they actually turned on that income rider and that income stream for that. Was that a Dalbar study, or where did the numbers come from there?
That's coming from Index Compendium, competitive analysis. So that there's about 40 carriers that report for them, and all the major, U.S. carriers are in there. And the rider study shows that at 70 and a half or 70.6, over 50% of all income riders are being activated. So when you look at the increasing withdrawal percentages that we offer on there, it really gives us a nice competitive advantage for those clients looking to solve for income down the need with a nice guaranteed roll-up and a high payout percentage.
Okay. And we'll leave this poll up for a little bit longer. We've had quite a few folks getting very interested in getting contracted with Voya here. And again, if you're not interested, please click no. If you are interested, please click yes. Then we can, as I reach out and follow up to you, I can get you the information that you requested, and we can get you contracted with Voya and help you get some of that business placed there. All right, I'm going to go ahead and move on to my final poll question of the day here. And that is, do you have any interest in the annuity alternative or learn about single premium life? And again, I'll go into this and sing the praises of single premium life. Looking back at my days when I was an advisor in a bank, I wish I would have either had or known about a product like this, because I would sit down with that CD buyer almost daily and ask them, what's important about this CD money to you? What do you want this money to accomplish for you? What's your goal with this money? And I would hear one or a combination of the three following things almost every time. It's there for a rainy day or a catastrophe. It's there if one or both of us need to go into the nursing home, but ideally we'd like to leave it to the kids and or grandkids. So we can take that CD money, reposition that into the single premium indexed universal life product. Now, if they need money, they can go in and take some of the premium back out if they need to. They can always take a loan against it. If one or both of them need to go into the nursing home, they're going to have the accelerated death benefit paid out over a 60-month period for just 2 of 6 ADLs if they just need home health come in to help them out. But if one or both of them actually end up in the facility and haven't triggered the accelerated death benefit rider yet, that will be paid out to them over a 36-month period, or they can choose to take it lump sum up front for a fee. And then the final goal was leave it to the kids. Well, even though this is a modified endowment contract, it does still in most cases pass to the beneficiaries tax-free. So now we've taken it, and what we see in most cases, especially for clients in their 60s, it about doubles. So if we put a $50,000 CD in there, in most cases we see that turn into about $100,000 worth of death benefit and or accelerated death benefit that can go to help offset long-term care costs that folks will face in all probability throughout their retirement years. 12% premium bonus on the Equitrust Wealth Max product. Some of the other products do have premium bonuses available as well. Typically we see higher commissions and also higher caps and lower spreads on the indexing options inside of the product as well. So if you would, again, like to hear more information about the single premium index universal life products and how you can use those to meet some of your clients' demands and help mitigate some of their risks while repositioning assets to line up more with their goals, check yes there, and we will follow up with you and get you some more information on the single premium index universal life products. With that, that is my last poll there. Brett, appreciate you attending today. Anything you'd like to say before we wish everyone a good day?
Yeah, I just want to thank you for the opportunity to share the Quest products with everybody, and hopefully we can help you guys with some case ideas for clients you're currently working with.
Again, Logan Ireland with Insurance Agency Marketing Services in Omaha. Our phone number is 800-255-5055. I appreciate everyone attending today. Hope you found a great deal of value in this, and happy selling out there. Have a great day, everyone.